at the moment, setting the stage for another volatile week in the markets. More trouble, the question is, for exchange-traded funds. As stocks tumbled at the open last Monday, ETFs not only followed suit, but they collapsed in a complete foul-up in market structure rules and the pricing of these exchange-traded funds. You had 30, 40, 50% losses on these ETFs at the open. And yes, individuals were sold out at these prices. You've been following this closely. Liz, what can you tell us?
Well, it's harrowing, unnerving moves to the downside in that it really was a flash crash. On a pure point basis, it was a bigger flash crash than what happened in 2010. So what's happening right now is no canceled trades, even though back in the flash crash of 2010, anywhere, a rough estimate, 60% of the trades that were canceled back then by market regulators were related to ETFs. So are ETFs a systemic risk to the markets right now? Are the markets not functioning properly? The answer is yes. We've talked to market regulators. We've talked to the NYSE, the NASDAQ, the SEC, and FINRA. They say they're all looking at the structure of the market right now. So, was it a structural issue or was it due to China? All of those forces coming together on that Monday. It wasn't just emotionally wide trading ranges because people were fearful. It was because these guys could not get any visibility into the underlying prices of the ETFs. And we had a crash, literally a 40% to 50% crash in some of these ETFs on that day.
Think about owning a dividend ETF and trying to sell it and losing 50% of your money in a morning. And I want to say this. Stop writing articles about the individual investor did not know how to trade them. You shouldn't have been trading at the open. You shouldn't have used market orders. You shouldn't have used a stop order at the open. Stop saying that, because these firms for a decade and a half at least have been selling these products to individuals saying, hey, they're better than regular mutual funds. You can trade them during the day. They're a better product. They're a better product and a better product.
Right.
Never warning them the possibility of, if you don't know how to trade these products, you could get your entire face ripped off. So I think that you want to read the risk disclosures. The risk disclosures are not significant enough to point to losses like that, Mike. Yep. That's my issue.
Agreed. And Carl Icahn would agree with you. He had that battle with Fink from BlackRock about that same issue. So, with the way technology has gone, with the faster markets that we have with high frequency trading, a lot of individual investors that don't have access to those type of algorithms that are part of the high frequency trading are kind of left behind here. So that's where I think a lot of people got hurt last Monday, was that they had limit orders in to protect themselves in an orderly market sell-off of 5 or 10% or wherever they placed their order to sell below where the market was. Well, the market dropped 50% in a matter of seconds after the open, and the reason was the stocks, the individual names that make up those ETFs, weren't open yet, and the market makers were not forced to show best bid and ask price on those stocks.
Here's what's going on. These ETFs were dumped without, to Mike's point, excellent point, ETFs were sold without regard to price, without regard to value. What was going on? Well, ETFs are no longer your plain vanilla products. They're highly leveraged products right now that the high frequency trading crowd uses. So, right now, what happened on Monday, as one economist put it, is sort of being treated like a UFO sighting, that something happened and we're just going to ignore it. The market regulators have to step in. We're talking $2.8 trillion sitting now in ETFs. Could go to $5 trillion, according to PricewaterhouseCoopers by 2020. That's a heck of a lot of money to have sitting in funds that can become highly illiquid due to algorithms.
They've got to stop.
And to market rules and pauses.
That's my issue. Is I don't believe for a second that any of these ETF providers ever thought that you would see orders filled down 30, 40, 50%, that people would be sold out at these levels. I don't think that they ever thought that, and they didn't fully understand the potential risk in the trading of them. And then I still heard people going on TV last week saying you can trade, you should put your money in an ETF, you shouldn't buy a regular old mutual fund.
Well,
because you can trade them. Well, you know what? You can't trade them.
You can't trade them.
At the moment you want to trade them, you can't.
This gets me so upset because they're touted to the little guy on television ads. Mike, do you think they should have better warnings than the boilerplate, sort of like a cigarette warning or a pharmaceutical drug warning? I mean, these are dangerous products right now that are being manipulated by high-frequency traders.
They can. I think if you wanted to take the other side, Liz, the people who structure these ETFs would say if you didn't have an order in there, an open market order, a limit order in the market, the market came down, but then they rebounded within 30 minutes to an hour. So you weren't affected unless you were actively
trading. I know that it happened within a half hour,
but at the same time,
still,
they market them as trading vehicles or a way to hedge portfolios. So
exactly.
I think that's agreed. But
and now they're shaking their finger at the individual investor saying, well, you didn't know how to trade them right. It's your fault. You didn't know how to trade them right.
Well, that's not, that is such a wrong thing to say.
It makes me angry.
It's not right.
I went back and looked at our segment last week on Coast to Coast. I'm just trying not to get that really angry face because my mother called me on the phone and said, you looked really mad. I don't know what you were talking about, but you sourpussing it.
Well, you tell your mom you were thinking about the little guy investor out there and you're worried about it.
And I think if regulators could come in and monitor this and really handle the high-frequency trading, Liz, I think they would.
Should they cancel the trades? Like they did in 2010 for ETF trades?
I think at this stage, no. I
they
think
probably
it's
won't.
Too far after the fact.
You know why they're saying no, we're not going to cancel trade? Because we had the rules in place since the flash crash to smooth that volatility. But guess what? The traders on the floor are saying it was those same exact rules that gave us little transparency and visibility into the prices of these stocks and the ETFs.
Right. So I think regulators are doing everything they can to keep up with technology, but I think the high-frequency guys are one step ahead of them again.
And to the person who said that these are the greatest invention for retail investors since the 70s, that's a load of horse hooey, and you doggone well know it. Try the democratization of information on the internet and actually knowing what your risks are and knowing what real-time quotes are.
Right.
So that's my say. Hey, Mike.